Hello and welcome to Investing Confidential. Have been doing many videos recently. By the way, I just merged my company, so that took a lot of time. And hopefully, I'll have some more time coming up, but I'm not sure. But I just wanted to comment here. I mean, like everyone's commenting on this market correction. I mean, I've been calling for this for a while. I've been wrong, but I also said that stay with the S&P because the S&P they don't want it to go down. And they don't want it to go down till it goes down. And we've finally seen what's happened. And as I told you, the everything in the world is dependent on the S&P 500. I've never seen this in my lifetime. And if the S&P continues lower, everything's going to tumble. It's like dominoes. And the key in the world is the S&P 500. When I say the key in the world, I mean not just stocks. I'm talking about everything. Economies, everything is tied to the S&P 500. It sounds insane, but in the U.S. especially, all of our economic numbers, everything has some kind of S&P 500 component. I mean, and consumer, all of these things, and now we're seeing the proof of it, right? S&P cracks, Japan destroyed. S&P cracks, Europe destroyed. I mean, it's across the board. Across the board. So some of these pundits, like say people on Wall Street, they're telling you the following reasons. It's the Fed. That's the consensus out there. The Fed, and then the trigger was the job numbers. Because unemployment, with a big jump, unemployment, it's triggering a recession. Look, I've given up trying to call the recession. We've been in a recession. I'm talking about Main Street, not Wall Street, and the financial assets and the elite. They don't know what a recession is. They're going to find out when elite recession is very soon. But in their mind, we're still not in recession. And you and I both know if you're working, if you're getting gas every day, going to some, we're in some type of downturn. And we've been in it for a while, but the numbers don't tell us this. And now all of a sudden, people are jumping at the numbers. Look, you blame the Fed. The Fed is a joke. We've talked about this for a while. Fed has no credibility. I'm surprised they stay as long as they have. Obviously, it's an election year, but they are seeing things that they're not talking about, especially on the inflation front. I mean, I'll just show a couple things. I mean, look at electricity prices. Okay, electricity prices, as you could see here, they've been going up for a while, and they've spiked, and they're not coming down. There's no sign. Okay, that's called sticky inflation. I'm not going to show any more charts of food. I'm done showing all these charts because they're all everything's coming to fruition. Everything is right. Everything I've been saying has been correct. Food has gone up a lot. It's not coming down. Not coming down. Then there's crude prices. Okay, the pundits are crude's down. Listen, let me tell you something. Never in my lifetime, when you have this type of Middle East tensions, do you see crude down for a long time. Folks, crude is going to go higher. It is going to go higher. We have incredible, and again, this is not mean political, but it's obvious. We have incredible weakness in the U.S. government, incredible weakness. We have incredible uncertainty due to the election. And we got two war. I mean, it's just unbelievable. So crude, with all of these tensions in the Middle East, is not going down. Not going down. And then you got the other thing is this job numbers. Okay, look, we don't care. The job numbers have been fake for a long period of time. They always skew positive. So if you're worried about the job numbers, you really should worry, because they're not supposed to show this kind of recession flags, right? They always skew positive, and it's election year, right? Look, again, not being political, all of this information comes out of the government. Bureau of Labor Statistics, these are all government agencies. They're all left-leaning, and they don't want to lose their jobs, so they want to be where the incumbent government is, right? They don't want to change. They want things to stay the same. So especially when you have so few people participating in these surveys. I mean, this is how the government gets this information. No one's participating. It's like below 30%. So these numbers are complete fictitious numbers, so they can be manipulated. And the job situation is worse than anyone's saying. I mean, again, I'm not going to show these charts. I showed them 6 months ago. So maybe, and then now you're coming to fruition. There's been massive layoffs in tech, massive layoffs in tech. And now you're seeing it all over the place. And again, if your job numbers are based on surveys and Indeed and LinkedIn and all this, which is what they are, okay, that's all stuff that can be manipulated. But at some point, it just can't anymore. And we're seeing that now. Okay, and then and then the US government blames the Fed also, right? So the Republicans are blaming Harris for the weakness. They're morons. And the Democrats are blaming the Fed. They're morons too. Look, both of these parties are clowns. They're clown shows, absolute clown shows. So let's look at the facts. Okay, why is this market going down? Let's look at the facts. Okay, forget about politics and don't even listen to what Wall Street tells you. They're as much clowns as the politicians. So what are the facts? Facts are, prior to this, the U.S. was the most overvalued, and this goes back only about a few months now, overvalued over the last 50 years, probably more like 100 years, but it's most overvalued 50 plus years. The breadth is the worst I've ever seen it, meaning small amounts of stocks moving the market. That's called the breadth of the market. That's really bad. It's the worst ever. Real estate is the most unaffordable in history in the U.S., most ever. U.S. debt to GDP is the worst in history. Okay, factoring out a war, it's the worst in history. We're about to pay $1 trillion. We're now, I think this month, $1 trillion a year annualized in interest payments. Credit card balances and defaults are the worst in history in the U.S. Bankruptcies are rising as a delta as fast as any time in history. We have 2 wars that show no sign of ending. Global inflation is still a problem. And for a lot of countries like Germany, they're in stagflation. Great environment, right? Hey, let's just buy stocks. And this is what people have been doing over the last 3-4 months. Not paying attention, don't care. Let me listen to my advisor. Let me listen to Goldman Sachs. Let me listen to the US government. Everything's good. CNBC, the clowns, Kramer, all these people that are just have a history of just destroying people's money, right? That's all they do. But they're on television, so people believe them. Great environment. It's laughable. Okay, so I'm going to tell you what I'm seeing. It has nothing to do with the Fed or anything else. I'm going to tell you what I'm seeing, because this is what the smart money sees. This is what the big money does. Okay, and it's in the FX market. Forget about, look, stocks are a joke. It's a sideshow. Bonds are a sideshow. These are illiquid markets. There's no liquidity. I don't care what you see, the volumes every day, irrelevant, because the volumes come in the morning and the last trade in the afternoon. In between, incredible. There is no volatility. There is no liquidity and massive volatility. So let me show you what I'm seeing. Okay, look at the chart here: U.S. dollar versus the Japanese yen. Okay, this is I did a couple of videos on Japan. Oh, no one cares, but no one talks about it. But look, bottom line is this movement, okay, in the Japanese market, the Japanese yen, because of what the Japanese government did, which is raise rates, right? This movement was predictable. But also, it shows you how illiquid things are. And what it does tell you is that money is flowing massively out of the US. Now, we haven't seen it yet in the bond market because everyone's buying. Idiots in the US are buying bonds. They think rates are going down because of the Fed. So U.S. investors had been, including, by the way, Warren Buffett, who's been selling, as you know. So we'll see in his filings. U.S. investors had to sell Japanese equities. They had to sell them because they knew that money was going to flow into Japanese yen, which was incredibly cheap versus historical, versus PPP, purchasing power parity. Everything was telling you the Japanese yen was incredibly cheap. And you knew that the money was already flowing out of US back into Japan from Japanese institutions, by the way, the largest holders of bonds in the US. And so US investors realized this trend, and they've been trying to sell. And finally, with the US market going down, they had no choice because they knew that the foreign exchange was going to kill them and is going to kill them. So they had to get out, and there's no liquidity. So boom, the market's destroyed, absolutely destroyed. So what happens now? Say, is this? I think it's just the beginning. Japanese money will continue to flow out of the U.S. bond markets and stock markets, mainly the bond markets, and especially with this bond market rally, right? So you got all these U.S. investors buying bonds because they think the Fed's going to cut. And the Japanese are selling, massively selling. Okay, let's look at another chart. Here's U.S. dollar versus the euro. Again, showing U.S. dollar weakness, by the way. I mean, we spoke about this. Look, at the end of the day, this is the beginning. I told you guys, you can go back, I don't know, maybe 6 months, all the inflation talk, great inflation. Not good. But if you want rates to go down and you want rates to go back to where they were, the next time, instead of manipulation, they're going to go back there because we're entering deflation. And if you think inflation is bad, deflation is the future, okay? And it's terrible. And it's going to be driven, this deflation, rates going back lower, is going to be driven by economic weakness, not by fake interest rates, the Fed. Okay, so if you want to see a preview, look at China. China is in deflation. It's destroyed. Stock market, bond market, everything is destroyed. I'm going to go into China in a second. They may be bottoming, but listen, let's just take it. So deflation is the worst thing for financial assets. We had inflation and then deflation in the 70s. And it destroyed real estate and that's the last time we had a real bear market in stocks, not these fake bear markets, 1987, the financial crisis. I mean, financial crisis was a 18-month correction, then we went back to new highs. The same thing with the 87 crash, supposed crash, that bottomed and we back to new highs. And then we had this pandemic crash. It wasn't a crash, it was a correction. Okay, and the same. So at some point, we're going to go into a bear market like we were in the 70s, 40, 50 years ago, when stocks go down and it takes years. Okay, the last bear market we saw was in tech from 2000. Took, 15 years to come back to the original level and make new highs again, maybe longer. That's a bear market. And that's what we're going to be entering overall in the stock market. So deflation, terrible for financial assets, stocks, real estate, bonds should be okay, especially if you're a US dollar holder. But the US dollar is going to get destroyed over time. It's lost its luster. Debt's exploding. Interest payments, I'd mentioned, $1 trillion a year. There's no way to get out of that anytime soon. Maybe if we have a president that comes in and sees, as rates go down, and sees the opportunity to extend maturities and lower that, but that takes years. It doesn't happen overnight. And volatility, folks, is going to explode 70s style. Volatility is going to be off the charts in everything because there's no liquidity. Look, there's nowhere to hide on this. Okay. Again, bonds, if you're a US dollar holder, okay. I think commodity exposure at some point will be okay, but commodities are going to get hit like everything else. I don't know about gold at this point, probably okay, but hard to say. Bitcoin, it's an asset class that's speculative, so don't know. And then we've got the big thing coming up, which is the US election. I will say that no matter who gets elected, it's the beginning of the end of this bull market is over. This financial bull market is over of financial assets. I'm just going to say that in general. This US election is a trigger, no matter who gets elected. It's not relevant. There's nothing that any of these two candidates can do to stop the inevitable, which is the decline in the US dollar. So if you want to know what's really going on, watch the US dollar versus the yen, watch the US dollar versus the euro, watch the US dollar index, which is how it is against, and watch commodity prices, especially crude. Because if there's something going on in the Middle East and crude spikes, then we're really in trouble because then we've got stagflation. But deflation is in the cards over time. It takes a long time. Doesn't happen overnight. And it's not good. So this has nothing to do with jobs. This has nothing to do with the Fed. It's everything to do with the currencies. So you investors out there, you be careful out there.